Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati. And in this podcast, I'm going to talk about what is the corporate bond yield curve telling you. Just to put it in layman terms, why is the difference between a corporate bond yield and the government bond yield so low? Many institutional investors are actually buying more government bonds rather than corporate bonds because they feel that corporate bonds are too expensive. The question is, are they expensive? And why are they uh, turning very turned have why have they turned expensive? Uh, what is the exact what are they really telling you? Does it mean that interest rates have peaked out and government bond yields can fall? Or is it that there is still a demand for corporate bonds, despite the fact that government bond yields have moved up sharply, and the investors believe that corporate bonds are offer better value given the government bonds, a huge amount of supply at the government bond level. So, just to give you a perspective of what I am talking about, the the difference between a 10-year government bond or say a PSU bond like a Bharat Bond ETF, which is a 10-year Bharat Bond ETF. The spread is what do you call it? The difference between the government bond yield and the Bharat Bond ETF. The spread is just around 40 to 50 basis points. Some of the bonds, 15-year bonds, the spread is even lower for PSU bonds, coming as close to something like 20 to 25 basis points. That is just a difference of around point to 25 basis points margin, right? So just to give you an example, you have PSU bonds 15 years being issued in 765, 770 levels. The 15-year government bond is around 735, 740 plus annualized. So it's just around these levels. It's very low spreads, and as the market, clearly there is a difference between government bond and corporate bond because government bonds are risk free, while corporate bonds carry credit risk as well as interest rate risk and liquidity risk. Now, if you take state development loans, many corporate bonds are actually similarly priced as state development loans. This is all on the AAA category. But even in the lower rated, if you go down on the rating curve, now, for example, many AA and A bonds, A rated bonds, that were trading at, say, 9 to 11% just year and a half or 2 years back, are still trading at those levels, despite the fact that government bond yields have risen sharply. So here also the spreads have come down, but there is stickiness at these levels. So I think here investors seem to be absolutely comfortable at these levels, and issuers are also finding that they are able to maintain the levels. And if they have to increase the cost of borrowing, then clearly it's a direct um, impact on their own businesses, and that's not the best thing that can happen. But especially at the AAA PSU bonds and high quality AAA bonds, the spreads are very, very narrow. So does it make sense to buy more government bonds and state development loans than corporate bonds? Um, I think the takeaway here is that at the longer end, that is anything over 5 years to 10 years and 15 years, it is best that investors, non-institutional investors, avoid those bonds. They're expensive, subject to interest rate risk, and clearly, in a very long term, it's best institutions take a call on those. They have a need if there is a PF or insurance companies, and if there are other banks and other things, other investors, then they have a longer term view on interest rates. Non-individual investors, non-institutional investors may not have such resources or the capability to form such views, It is best to invest in the shorter end, 1 to 3 years, where yields are actually higher than many of the longer end bonds. So most of the shorter end bonds of AAA issuers and AA high good quality AA plus issuers, 2 to 3 year bonds, are all in a range of around 7.75 to 8% levels. And if you go down the rating curve, they are going to 8% to 10% as well, depending on the bond, largely in 8% to 9% levels. I think non-institutional investors are best investing in the 1 to 3 year maturity segment and not look at longer term bonds at this point of time or at any point of time unless there is a specific need or unless there is a very strong view that interest rates can come down and there is a very strong possibility of capital gains. But that is best left to your financial advisor and the experts to tell you. Thank you very much for listening in. Do not forget to follow us on all podcast channels and do send in your comments if any.